Multifamily underwriting is how you analyze deals. So you get a specific set of information, and then based on that information, you can then analyze a deal. One, you'll need the purchase price. Two, you'll need the NOI, which is the net operating income, and the cap rate. Easiest way to explain this cap rate is if you were to buy a property for all cash, this is how much income it would produce. So say you see something that's like a 5 cap and you bought the property for $100,000, that would produce you 5K of cash flow. Now all of these relate to each other. So the purchase price, the NOI, and the cap rate, it's like a triangle. If you have two sides of the triangle, you can solve for the other side of the triangle. So in order to find out the cap rate, you would take your NOI and divide it by the purchase price. In order to find out the NOI, you take the purchase price and you multiply it by the cap rate. Now that you know how these things work, let's get into an actual deal. So I've already underwritten this deal. I've done the math, so I'm not sitting here for 20 minutes with my calculator, but please follow along, and this is how we'll start. So in this deal, I use abbreviations. PP is purchase price equals $13 million. It's 100 units, and the average rent is $1,400 a month. But Jesse, you said I needed the NOI and the cap rate. How am I going to get it with just this information? Well, the first thing we're going to do is calculate the income. So we're going to take the rent. We're going to take 1,400. Yikes, that 4 is brutal. Multiply it by the 100 units. And we're going to multiply that by 12 because there's 12 months out of the year. And this is going to be our gross rent. So our gross rent is $1.68 million. Now, out of that, in order to get the net operating income, we have to take out what's called vacancy. Even if your property is 100% occupied, the bank, when they go to give you a loan, is going to underwrite the deal at a certain vacancy, between 5-10%, even higher depending on what asset class it is. But let's do 10% vacancy, just to be conservative. So if we subtract 10% from 1.68 million, 1.512 million, this is 1,400 times 100 times 12 to get 1.68 million. This is your gross income. You're going to remove the vacancy of 10%, so you can multiply 1.68.9 to get this number. And then we're going to take out our expenses. Now, a conservative underwriter, like we are, is going to use 50% for our expenses. This is not debt service. This is operating expenses on the property. This is repairs and maintenance. This is payroll. This is property management. This is utilities, trash, all of it. This is your property expenses, your taxes, your insurance. All of that's included in here. So if we take out 50%, we now have $756,000. And this number right here, this is our NOI, our net operating income. So let's add it up here. Our NOI equals 756K. Okay, so the red one's a sticky marker. If you remember the triangle earlier, how are we going to get the cap rate? What we're going to do is we're going to take the NOI and we're going to divide it by the purchase price to get our cap rate. So we now have our NOI of 756. So we'll take 756 divided by 13 million, and that will give us a cap rate. Do it on your own. Do 756,000 divided by 13 million. That's going to give us a cap rate of about 5.8%. So we know that this property, if we were to purchase it all cash, would produce 5.8% return for us if we were to buy it all cash. So we can write this up here. Our cap is now 5.8. So now that we have all of this information, we can start doing a little bit of cash flow analysis. But first, we need to see debt service. We know that this property is going to produce $756,000 before we pay the debt service. So the banks right now have lowered the loan to values that they're giving. They used to give like 80%, up to 80%, which is a little bit crazy in my opinion. I think you should be conservative. I like the 70-65 range. But let's calculate some debt service. We're going to be conservative. We're going to start with 60% LTV. 60%, this is a loan to value. So at 60% loan to value, we're going to take 60% of 13 million, which equals $7.8 million. What's the rate on this loan? If this is a fixed rate loan, they're going to use the 5 or the 10-year treasury for this. So let's say we're going with the 5-year treasury rate. The 5-year treasury is 4.62%. Now you might be thinking, oh, that's a good rate. Well, here's what happens. The bank is going to add a spread on top of that. Bankers always got to get paid. Is going to add 2% to your rate. So now your all-in rate is 6.62%. This is now your all-in interest rate. Now, if you were to get interest only on this loan, IO is interest only, your payment would be $516,360. What about when the interest only period is over? What do? You need to know what your debt service is going to be when the interest only period is over. What we do to calculate for that additional payment is we add anywhere from 1.5 to 2% to calculate your principal pay down. I'll add 1.5 in this example. 8.12% is now our principal and interest payment. So our P&I payment is now 8.12%. So if we don't get interest only or our interest only term expires, this will be our approximate payment. Now this is just napkin underwriting, so these are not always the most exact figures. You'll run through a mortgage rate calculator and you'll get all of this information from your debt broker. Just for napkin underwriting's sake, we're going to go with adding 1.5 for the principal. So our 8.12%, now our principal and interest payment on 8.12% is $633,360. Now that we have our debt service number, we're always going to underwrite with our principal and interest number because we have to be conservative in our underwriting. We're now going to do what the bank requires us to do, which is have a certain amount of income to cover this debt. The bank requires a debt service coverage ratio from 1.25 to 1.35, 1.45, depending on the bank, the type of property, the loan. At this point, we're probably looking at 1.35. We used to go about 1.25. To calculate this, we're going to take our NOI and we're going to divide it by our debt service. So taking these numbers, we're going to do 756K. We're going to divide that by 516K. And we're going to get a debt service coverage ratio of 1.19 is a lot less than 1.35. So this property, we would not be able to get a loan at 60% loan to value. So what do? We now restart this and we write it at our next value. So using the same math, we're now going to go with a 50% loan to value. 50% of that, that's a $6.5 million loan. The $6.5 million loan with the same interest rate from before. So we have the 4.62 5-year treasury. We're going to add the 2% lender spread for our principal and interest. We're going to add that 1.5%. First, we'll calculate our interest only, which equals the 6.62%. And our interest only, 6.62% on 6.5 million, that equals $430,000. Annual debt service, $430,000. Now when we're going to add in our P&I, add in that 1.5%, so we're principal and interest. That rate is 8.12, horrible 8%. And that debt service payment is $527,000. Same as before, to calculate our debt service coverage ratio, we'll now take our NOI of 756K and we'll divide it by the debt service, which is 527K. Our debt service coverage ratio equals 1.43. So we're over the 1.35. The property can service its debt. The bank will likely give us this loan, and our debt service coverage ratio is 1.43. That is at 50% loan to value. Now what? What do we do with this conglomerate of information? How do we know if this is a good deal? Now that we've calculated our debt service and our debt service coverage ratio, we can start to see what our cash flow is going to be. Our debt was 527K. Debt service coverage ratio, 1.43. This is what goes with that. First of all, what do we need? Cash to close. So we need to know our down payment, which is $6.5 million. Our closing costs, and calculate that at around 5% to be conservative. 5% of the purchase price, that is. And there's also lender fees. They seem to forget about the lender fees. The lenders charge points on the loan. The lenders charge service fees. The lenders charge rate buy downs. If you bought a rate cap, there's a bunch of different lenders fees. So I'm going to do the same. I'm going to do 5% again, just to be conservative. So we know cash-wise, in order to close this deal, we need to bring in a total of $7.8 million. So we need to raise $7.8 million and bring that in however we have that money. Now, if we don't use all of this, say our lender fees only wind up being like $350,000, we then have an additional $300,000 buffer that we add to our reserves that we can use later down the line if needed. $7.8 million. So we need to bring in $7.8 million to purchase this $13 million asset. So we want to know what our cash on cash return is. What are we going to make off of our $7.8 million investment? So in order to calculate the cash on cash, we're going to need to know what our free cash flow is. So in order to get our free cash flow, we're going to take our NOI and we're going to subtract our debt, and that's going to equal our free cash flow. $756K, we're going to subtract $527K, and we're going to get $229,000 of free cash flow. So free cash flow, 229. I know it's getting a little messy, a lot of information here, but in order to get our cash on cash, we need that free cash flow number. So now we're going to take our free cash flow of $229,000 and we're going to divide that by what we invested, which we know to be $7.8 million. And that equals a whopping 2.93% cash on cash return. 2.93% is not that great. So the problem on this property is the cap rate, 5.8, is lower than our debt rate. And since it's lower than our debt rate, we need to bring a whole bunch of cash into this property to even make it make sense. Our cash on cash return is equal to 2.93%. What if we were able to raise the rent on this property? What if $1,400 is below market rents? What if market rents on this property is $1,600? And now we're able to increase the income by a delta of $200 a month. So what would that do? Let's take $200 times 100 units times 12 months. So we take our new rent, our $200 a month rent increase, over 100 units times 12. This produces $240,000 of new income. We know that we can, with this rent increase, we can create $240,000 a year of new income. $240,000 a year. So we've now added $4 million of value to this property just by increasing that rent. We have $4.13 million of new value that we've created. So our NOI is $756K. And then if we add our new value of $240,000 a year, our new NOI is $996. So the property is almost producing $1 million a year. So if we take our new NOI divided by our cap rate of 5.8, we now have the new value of this property is $17.17 million. So we've increased our value by $4 million. And when we go to exit the property, say we exit after we do those rent increases, we sell the property, we're going to make whatever we paid down on the debt plus this forced appreciation. So what we have to decide as an investor, is it worth risking $7.8 million to make a 2% cash on cash return, potentially get higher as we raise rents, and potentially add $4 million of value? Or should we look for a deal that's a little bit more cash rich? See, instead of being in the 50% range, I don't necessarily love putting 50% down. I'd like to be in the 60 to 65% loan to value range. But we know this property particularly can't service that debt. And with our cash on cash so low, you'd rather just put your money in stocks and bonds and make more than 3%. Yeah, you'll get tax write-offs. Yeah, you'll get the appreciation. But at the end of the day, this deal itself, not really worth going after. Now, if this is a Class A asset and there's some value add that we can do to increase the rent, maybe. But honestly, at this point, this would be a deal that we'd pass on. I wouldn't do this. And this calculation takes so long to do, all to find out that you're not going to do the deal. So what we've come up with, instead of this, we have a software. It calculates all of this for you. And within moments, it lets you know, is the deal worth it or not? So this took 15 minutes or so to underwrite a deal. We've narrowed that down to 2 or 3 minutes, and it spits out the entire report for you. If you're interested in checking out our underwriting software, click the link in my bio.